Hello everybody, my name is Brian Downing. I just wanted to show you a couple of quick discoveries. I'm going to show you how to optimize, or the results of optimizing your portfolio and how it affects your next session of trading. So my last video here entitled Most Volatile Currency Pairs for Effective Forex Automated Trading, put out October 5th. 2017. So this has just been done in the last 2 days. So this is fairly fresh what I'm looking at. So continuing from this point, what I've calculated is, and I've talked about it in that video, about if I did an analysis on, let's say, the top 5 most volatile currencies. Now, I did a bunch of tests where I have a script that does exactly portfolio optimization. It's a Python script that I highlighted quite a while ago. But basically what it does is when you run it right here, there's a bunch of tests that you could do. So in this case, I've run it against 2 of the most volatile pairs, which were you can see here, the South African Rand and the Japanese Yen, and the other one being, let's say, the New Zealand's Swiss franc. So what I decided to do is I did a test of the top 5. So if that was the case, I've run it, which is of course the Rand against the Yen. The second most volatile is USD. Not sure, but the let's see, we got the New Zealand Swiss franc, the New Zealand Canadian dollar, the New Zealand Japanese yen, and the USD Swiss Swedish kroner. So we've come across some testing, and as I said in this script, what it does is it will all the data that I've collected, as I showed in that previous video, it goes back a full year of minute data, so it's quite accurate, pretty low level. So in this case, we do an analysis all the way back to almost 1 year, probably 11 months worth. Then what this script will do, it will spit out the expected returns of these trading of these pairs, and then what it will do, it will take a covariance matrix of a relationship between each of these that are listed. And then using all these different type of ways to mix up your portfolio based upon your trading, you could do minimum variance portfolio where it's a long only. So it'll spit out the optimal weights if you wanted to get the expected return of this, and there will be the expected variance, and of course we have to measure the Sharpe. Now, because we are using highly volatile data sets, obviously, really, I should be using Sortino because that will smooth out this result. But just for now, I just wanted to get a gauge on what would be the best portfolio strategy type on the allocation of the weights for my trades when I put on positions. So essentially what we're talking here is these are for the next, I'm going to use as a trading session. So as I said in the previous video, the best way to trade global trading currencies is to trade the most volatile at the next trading session. That would be timed with the London Open because of the global volume mostly falls at that time for global volume of forex trading. and then do another session following up with New York. So essentially what these weights would do is would set up probably, you could say, the next trading day and what kind of weights I should put on based upon what I'm seeing, as just as a suggestion to get these expected results. The expected return, the expected variance, and the expected Sharpe ratio. So as I said, the first one that we want is a minimum variance portfolio, long only, but we can also do a short as well, not only with the long. So continuing along, we also use the Markowitz portfolio, and then we try to have a long only with an expected target return of this. Again, we measure the optimal weights to try to get this return, as well as we have our expected return, variance, and Sharpe ratio using the strategy portfolio type. And then of course we have also the Markowitz long short combination. Then we try to do a market neutral Markowitz portfolio, and that's pretty well it. Okay, so knowing all that juicy information, what I want to do is, here's the thing. Depending upon your trading strategy, in my case, I will be trading intraday. So this is really the only highly volatile period that I want to look at. I'm not going to care about any of these, but this is just for other long-term strategies if I want. But for now, I just really want to focus on this time period of what the most volatile are. So let me just make sure we're getting this right. Okay, so we're going to sort in a descending order on column C. So just want to make sure that everything lines up as we would expect. So again, for the most volatile over a 7-day, we have the following order. Rand, Japanese yen, correct. New Zealand, Swiss franc. New Zealand, Canadian. New Zealand, Japanese yen. USD, and Swedish kroner, sorry. So we've done this correctly on this run with this particular set of forex pairs if we were to trade them the next day, as an example. So knowing that, here's what we can, one of the major things that I wanted to highlight here is here's the expected returns and average returns. Now this is really important to note. If we were to trade the next day or the forecast over the next short-term period, maybe a day, a couple of days, or next trading day, these are the expected, the average returns that we have. We have the Rand, Japanese yen giving a positive return, average return. We also have a negative on the New Zealand Swiss franc, negative on the New Zealand Canadian dollar, but we have a positive for the New Zealand Japanese yen, and again a negative average return on the USD Swiss kroner. So these covariants can be important. And then again, we have here a mix of the long, where these are the optimal weights to get maximum return. But when you look at the Sharpe ratio that is expected, it's negative. Minimum variance portfolio, long, short, doesn't matter. It's still giving us a potential negative Sharpe. Same here on the Markowitz portfolio, long, short only, with a target return of negative, or, well, expected sharp, so the performance will not be that good. Markowitz long-short combination. This is going to be negative. Markowitz portfolio, market neutral, again negative. Okay, so if I was to look at the second one, which I ran, now in my previous video I showed you, in this particular video I thought, oh well, maybe if I only run the most two volatile currencies. So what we have here is really the only two ones that I'm looking at are the Rand and Japanese yen and the New Zealand Swiss franc. Okay, but look, when you look at the average return of the New Zealand Swiss franc, it's negative. Okay, so we don't really care at this point about the covariance. And again, we come back with a negative Sharpe ratio, another negative Sharpe ratio, negative expected, and these are expected Sharpe ratios in that are negative. Okay, but what would happen if we just only focused in this test here, only those average returns are positive? So we know that the the Rand and the Japanese is positive, but what happens if we ran it with the, like I said, the Rand and the Japanese yen is the most volatile, but yet we only picked this as the second one of the New Zealand Japanese yen. Now, I did say in that previous video that when there's something volatile, usually the yen is the is only the positive, is used as the safe haven. But I find it really funny where if that is used as a safe haven, you have volatile currencies, which I highlighted here about 2 weeks ago, or maybe, yeah, almost 2 weeks ago. The most volatile currencies, oddly enough, were the Rand and the New Zealand dollar. Now, the reason for the Rand is volatile is because of the political turmoil that's happening in South Africa. Not only that, but there's a lot of negative data coming out of South Africa, and one of the big ones is a huge capital outflow out of the stock market for the Rand. Now, the other big news item that drove the New Zealand dollar against the Japanese yen was the basically the election that happened in New Zealand, and that was about 2 weeks ago, and that brought didn't have a lot of clarity to that election, which drove the currency, I would assume, to being very volatile. So, as I said, we did the analysis on just the South Africa Japanese yen and the New Zealand Swiss franc, which again, the Swiss franc is considered a safe haven. But guess what? If we take out this guy and did a test against great. Oh, yeah, here. Okay, so let me just get this set up. Okay, so again, let me just highlight what we're trying to do here. Okay, so we wanted to have the 5 most volatile, right? So what we've done here is we've done another run of only the Swiss Japanese yen and as well as the New Zealand dollar with the Japanese yen. And we're only picking that one because it's the only other one that has a positive average return. And again, that's over the last 11 months, roughly, with nothing but minute data. So it's very accurate. So let's do a comparison between this mix of assets and this mix. First of all, what you need to understand is the Sharpe ratios in all of these strategy types are all positive. Okay, that's a very good trend because in here, I think all of them are negative. These are the expected Sharpe ratios. But this one, they're all positive. Okay, not glorious returns or expected returns, but they're positive. And remember, we're not using any form of leverage. So this might be, if we were to trade this may be a good combination to go with, where we have the Rand against the Japanese yen and the New Zealand dollar against the Japanese yen. Because when you look at the returns, expected returns, just barely they're positive. So here's our covariance. Okay. So essentially, what we're trying to do is we're trying to get optimal weights on where we can get the highest expected Sharpe ratio. So judging by things, let me just see what would give you, this might be the highest, or maybe this one. So if I'm not mistaken, this may be your best market neutral for Markowitz because that gives you the highest expected Sharpe. So here's our mix on what we need to do on our portfolio, I believe. Yeah, and then this should be our expected return. Let me just see. See, the numbers kind of look funny based upon the averages, but if we were just to focus on the Markowitz, long only and long short, yeah, this might be your best bet gauging. Now, of course, this could all be wrong based upon the calculations, but judging from the combination, this may be the best strategy because it gives you the highest expected Sharpe. So you long this and short that combination with these optimal weights, but they're kind of messed up. But I do find this quite interesting for this mix of a portfolio. So let's see if we can get the performance on these. So let's see how the performance is for these guys. So if I do, let's see if what happens then. So that is what's the time? 1 day, 1 week, 1 month, 1 year. But let's look at the 12-hour. It's bouncing around with an intraday swing of not much. Now let's do the same thing with the other one. So that's daily FX. That's XE. Let's try this one. Actually, no. We want Let's use the same site for the charts. So here's a 1 day from 8:35 to 79.90. 12 hour. Let's see. Just as a test, most volatile currency intraday. So here's a chart according to Oanda. The markets aren't open right now. So let's say 1 day. Price movement. So the euro, British pound, euro, Austrian dollar, Australian. So see, they don't include all the majors. See, another thing I did mention in this combination is I got to make sure that my broker Dukas copy, I can trade these. So I have to filter out the volatility list to make sure I'm able to trade those. So that's obviously an important combination. But here we've got quite a few of combinations already. So we've got 39 combinations. So let me just see here. Let's see if I can get a better site. Let's see what Dukas copy has. Forex daily trading. Daily trading range. So no, I need has more selection. Don't want brokers. Yeah, it's pretty tough to say. But it's an interesting test, that's for sure. Because I can tweak the to get a more accurate, not be 11 months, maybe do 3 months or something. So I could tweak it and get a better rating. But I'm just thinking. But lots of testing here. That's for sure. So let's see if I look at 1 year. I mean, I don't know if I'd consider that volatile or that volatile. But let me just see the euro, typical euro dollar. Probably more stable. So if we want a year, See, it's had much higher performance. But question is, has it moved a lot? So it's only moved percent-wise, maybe 10%, roughly. Where this has gone up and down, maybe not as much. 7 to 9. That's definitely a bit of a rise, but it's interesting that this is definitely more volatile over the last year, whereas let me see a more less more stable. So if I use the euro, no, let me euro GBP. Euro GBP. Okay, so we want last year. Wow, that's volatile. But you see the moves are only in the, again, 10% range. Whereas this has moved a little more, not much. But this has definitely moved more. Not much I can tell from this. There's a lot of testing still to be done, but I have to test it against Ford tested. But just wanted to showcase what the strategy is on these reports here from these scripts. Just thought I'd show them. So based upon these two, from what I'm seeing, market neutral for Markovitz might be has a higher Sharpe ratio. Yeah. All right. Well, hopefully make heads or tails out of that, but let me know what you think later.